Do you know all the ways that you can take money out of your 401k plan and not be assessed an early withdrawal penalty? Well, we're going to talk about how you can take money from your 401k in a 3-part series, so stay locked in. Hi, my name is Carson Graves, Certified Financial Planner and President and CEO of the Retirement Education Center, and I want to welcome you once again to our Tuesday Tips, where today we are going to be discussing how you can take money out of your 401k and not be assessed an early withdrawal penalty. Now, this is going to be a 3-part series, and today we're going to be talking about distributions from your 401k from the pre-retirement perspective. So let's go ahead and jump into our lesson. So as I mentioned, we're going to do a 3-part series here, and there are 3 types of distributions that you can take from your qualified plans. The first type is the pre-retirement, so we're going to be talking about that today. Second, you can do a post-retirement distribution from your 401k. Most people understand that. And lastly, we're going to talk about what happens to your 401k after you die. How does your beneficiaries, how do they take money from your 401k plan? So let's talk about the pre-retirement distributions. When it comes to pre-retirement distributions, this is going to be for a participant who is still working for the employer and they are still participating in the plan. Now, if you are in this situation, there are some things you need to know about your pre-retirement distribution. I'm going to go over that. First, this is known as an in-service distribution, okay? That is what it's called, an in-service distribution. Ideally, you're going to want to be over the age of 59 and a half. Why? Because if you take money out of your 401k before that time frame, you may be assessed a premature distribution penalty of 10%. So you don't want to do that. You want to avoid that if you can. Now, there are some exceptions to that. And if you fall under those exceptions, you will not be assessed that early withdrawal penalty. But you have to know that you fall into the exceptions. Also, if you do take this money, your plan administrator is required to withhold at least 20% of those dollars. And that money that you do receive will be counted as ordinary income to you. Now, you can avoid that. If you take an in-service distribution option over the age of 59 and a half, you can do an in-service rollover. So that means that if you're over the age of 59 and a half and you have money inside of your 401k, if you would like for someone else to manage those dollars, maybe they give you more options outside of the 401k, you can literally roll those dollars over into an IRA, whether it be a traditional IRA or Roth IRA. You'll want to talk to your financial advisor about this, and you're also going to want to check with your plan administrator to see if they allow it. But if they do, you do not have to take that money and have 20% withheld, and you do not have to be subjected to any ordinary income taxes. You can simply roll that money out of that 401k into an IRA and let that money get managed in a different way and perhaps give you more options on those dollars as well. Now, as I mentioned, there are special rules that do apply to in-service distributions in your pre-retirement years if you are under the age of 59 and a half. You can avoid that early withdrawal penalty if you fall into these particular situations. 1, upon death. If you pass away, your spouse will be able to utilize those funds, if needed, before the age of 59 and a half, and they would not be assessed a 10% early withdrawal penalty. Another exception is disability. So if you do become disabled before the age of 59 and a half, you also would not be assessed the early withdrawal penalty. And of course, we already mentioned the golden age of 59 and a half. If you are above the age of 59 and a half, you can take money out of that 401k and not be assessed that early withdrawal penalty of 10%. Also, if you do fall into any type of hardship, now, there are hardship clauses in certain 401ks, and if you fall into the category of a hardship, you can also receive those funds and not be assessed that early withdrawal penalty of 10%. But one thing that I do want to make clear, if you take money out of that 401k, no matter what situation you may fall into, taxes are always going to need to be paid. So you can never avoid taxes, but you can avoid that 10% early withdrawal penalty. Thank you again for tuning in to our Tuesday tip. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today. We also would like to hear from you. Tell us in the comments section what you think about taking money out of your 401k. Have you ever done it? And what situation did you fall into when you took money out of it? And if you found this information to be beneficial, all we ask is that you subscribe to our channel, like this video, and share with others.